For decades, investors believed markets were driven by fundamentals: corporate earnings, innovation, economic growth. But over the last 15 years, something changed. Trillions of dollars flooded into the financial system. Interest rates collapsed to near zero. Asset prices exploded. And slowly, the entire market began revolving around a single institution: the Federal Reserve. Hello everyone, my name is Ledger. And today, we're breaking down how the Fed reshaped modern financial markets. The Federal Reserve has become the gravitational center of modern financial markets. Officially, its role is straightforward: maintain stable inflation, support employment, and preserve economic stability. In reality, its influence extends far beyond the economy itself. By controlling the price of money and the flow of liquidity, the Fed now shapes the behavior of nearly every major asset class: stocks, bonds, real estate, crypto. Modern markets revolve around liquidity conditions more than most people realize. And over the last 15 years, that relationship has become increasingly difficult to ignore. It begins with interest rates. When the Federal Reserve cuts rates, borrowing becomes cheaper throughout the system. Corporations refinance debt, increase buybacks, and take on more leverage. Investors move capital out of low-yield bonds and into risk assets in search of returns. Cheap money has a habit of making everyone look like a genius. The periods following 2008 and 2020 made this painfully obvious. Near-zero rates acted like fuel poured directly onto financial markets. But low rates alone were not enough. Once rates approached zero, the Fed deployed an even more powerful tool: quantitative easing. QE sounds abstract and technical. The mechanics are simpler than they appear. The central bank creates liquidity and uses it to purchase treasuries and mortgage-backed securities at massive scale. Following the COVID crisis, the Fed's balance sheet expanded to nearly $9 trillion. That liquidity did not remain trapped inside the banking system. It spread everywhere. Bond yields collapsed, risk appetite surged. Valuations expanded rapidly across equities, housing, venture capital, and speculative assets. Markets spent more than a decade learning a dangerous lesson: bad news often leads to more liquidity. This dynamic eventually gave rise to what traders call the Fed put: the belief that if markets fall far enough, the central bank will step in to stabilize conditions through rate cuts, asset purchases, or emergency intervention. Whether policymakers openly admit it or not, that expectation has fundamentally altered investor psychology. Markets are no longer driven purely by earnings, productivity, or fundamentals. They are heavily influenced by expectations surrounding liquidity support. And the consequences are difficult to ignore. Easy money inflates asset prices faster than the real economy. Wealth inequality widens. Speculation accelerates. Weak businesses survive longer than they otherwise would because debt remains artificially cheap. The Fed did not invent speculation, but it certainly subsidized it. We saw versions of this before the 2008 financial crisis. We saw it again during the everything bubble of the 2010s and early 2020s, when virtually every asset class inflated simultaneously under years of ultra-loose monetary policy. Then comes the reversal. When inflation forces the Federal Reserve to tighten policy, liquidity begins to disappear from the system. Valuations compress. Volatility returns. Investors suddenly rediscover the existence of risk. And when liquidity disappears, confidence usually disappears with it. The tightening cycle of 2022 reminded markets of something they had not experienced for years. Money is not supposed to be free forever. Still, the broader pattern remains remarkably consistent. markets weaken, financial conditions tighten, pressure builds. Eventually, policymakers pivot once again. The cycle continues. Central bankers often present themselves as careful technocrats fine-tuning a complex machine. In practice, they are frequently reacting to distortions that years of easy money helped create in the first place. So how should investors operate in this environment? First, respect liquidity. For better or worse, modern markets are deeply dependent on monetary conditions. Fighting the Fed during aggressive easing cycles has historically been a painful strategy. When policymakers inject liquidity or signal accommodation, risk assets tend to respond positively. Liquidity changes behavior, sometimes rationally, sometimes not. Second, understand regime changes. In tightening cycles, quality matters more. Strong balance sheets, durable cash flows, and reasonable valuations tend to outperform speculative growth fueled by cheap capital. During easing cycles, the opposite often happens. Investors move further out on the risk curve. Growth stocks, leverage, and speculation return aggressively. Third, diversify beyond traditional financial assets. Gold, commodities, energy, and certain international markets have historically performed well during periods of monetary expansion and currency debasement. Real assets matter when money itself becomes less scarce. And finally, remain disciplined. The Federal Reserve can extend market cycles far longer than many investors expect. Liquidity can keep bubbles inflated for years, but when the reversal arrives, it rarely unfolds slowly. Always manage risk, avoid excessive leverage, and never assume central banks can permanently eliminate market cycles. Because they cannot. Bottom line, the Federal Reserve exerts enormous influence over modern financial markets, but it is not omnipotent. Inflation, geopolitics, fiscal policy, and external shocks still shape outcomes in unpredictable ways. The goal is not to predict every Fed meeting or react to every headline. The goal is to understand the deeper structure of modern markets. Liquidity drives behavior. Investors who understand that reality tend to navigate cycles more effectively than those still relying on outdated assumptions about how markets are supposed to function. Modern finance rewards those who understand the flow of money. Everything else is mostly noise. If you enjoyed this video, subscribe to the channel and leave a like. It genuinely helps support the content. And more importantly, let me know your thoughts in the comments. Do you think modern markets are still driven by fundamentals? Or have they become completely dependent on central bank liquidity? Also, let me know what topics you want to see next on the channel. Thanks for watching. I'm Ledger, and I'll see you in the next one.